realize we'll be somewhat brief tonight, and we'll certainly be looking to get into a much lengthier discussion and answering questions in more detail at future meetings, including potentially a work session. But my role is as an investment banker on behalf of the city to structure and sell to the market their municipal debt. And so when they went and looked at doing this project, they knew they'd have to take on debt, whether it be through a tax increment financing district or a portion of the debt that they would issue kind of under the own auspices of their governmental powers. That is to be the case, and as I said, we'll certainly be happy to get into and expect to get into all the specific numbers with you. Of course, we would look at this and tend to describe it as an opportunity, not only for the city and the developer as well, but potentially for the school district. And we want to, while certainly having the project move forward, we want to be able to propose and craft an agreement with the school board that is as fair as possible, especially in light of these tough economic times. The main takeaway, the reason we would even be here talking about this, is that you, right now, from your perspective as a district, from the City of South Euclid's perspective as a municipal government, there's an asset there, and it's worth X amount of dollars. When this project is constructed and opened up, depending on what happens with the current value of the property, and as you are aware, those properties will be demolished, the buildings will be coming down. So the current value is X amount, and it'll be obviously reduced as the buildings come down. At the end of the day, when the project is completed and valued, you're looking at tripling, at a minimum, tripling the value of the asset that you right now get tax revenue off of. And so we've tried to craft our proposal to you with that in mind, to allow the schools to have some upside and be able to take advantage of that increase in value in the asset that we call Cedar Center North. We certainly, and I don't want to understate this, we certainly understand the tough economic times. All governmental entities are facing that at the moment. I will say, in dealing with at the staff level right now, they have certainly made that clear. And have, I think, represented the district's interests very well. We by no means are coming to you with an agreed-upon agreement. It's your decision. We understand that. We hope that we can have the conversations in the future to, in a sense, sell you why this is important to do now, and that we may not have the opportunity to do this type of development, certainly in the near future. And so that really leads to what our specific request is. And I'd like to just list what the TIF agreement would be in terms of proposal to the board. The first one, obviously, when we talk about a TIF, what is the term and what is the amount going to be? Because of that differential in development costs, the proposal on the table to the schools from the city at this moment is a 100% TIF for 30 years. You're all aware that that's the maximum that can be done under Ohio law. The economics that we have tried to structure at KeyBank to minimize the debt overall to the project needs as much money as possible out of the TIF to be able to finance bonds, not only through the TIF itself, but bonds that will be sold and paid for by the city. And we certainly will get into that in its specifics, but it is clear, and the city acknowledges this, the city will have to issue bonds, and is prepared to do so, issue bonds on their own outside of the TIF to complete the financing package for this. So the city is, and this is actually one of the points I'd like to point out in a minute, the city is prepared to issue its own debt and is not looking for the schools to subsidize their own debt. They will pay out of their own funds over the 30-year period dollars on their portion of the debt that is over and above what the TIF is expected to generate. I believe you have, but we will look forward to getting into more detail a projected analysis of revenue of this project, both for the city and the schools. I want to say right up front, we did it as a starting point. I think in the cover memo, we pointed out that there are some items that we are not the experts in when it comes to the school side of the equation. Had some preliminary feedback from school staff. So we look forward to reviewing that with you in detail and frankly getting your feedback and input on that. Because at the end of the day, we want the schools to win, we want the city to win, and I don't think it's a bad thing to say we want the developer to win, because the developer needs to win in this for the community and the governmental entities to win in this. It's going to do no good to open up a shopping center and then a few years later we're back to vacancies and on the residential side, if for some reason that didn't work. So the project has to be successful, and we have to prepare it to be successful for all of us to win from it. The last major piece in the proposal does have to do, as I referred to earlier, with we'll call it the city's debt. As I describe what a TIF is, TIF bonds can be sold and paid for, as we've said, with the increased real estate taxes. But because of the high development costs with this project and frankly the change in the market over the last 6 to 9 months, the city, as I said, will have to issue a portion of the debt as its own debt and pay for it out of its own fund. And so the city has acknowledged not only that they would do that, but that they understand that that in partnership with the schools would be foregoing future revenue, and that the proposal on the table, we would not want to harm the schools and allow the city to, in a sense, get off free without having to make any payments of their own. So what we're doing is we're establishing a minimum payment that the city has to make on its debt, regardless of what the TIF revenues are in a given year. So what I mean by that is the city will agree to pay $226,000 a year towards its debt, regardless of what the amount of TIF revenues that come in and are generated by the project. Why I think that's important is if that arrangement is not made or not in there, then theoretically we could have a year where TIF revenues come in and they cover all of the TIF debt and potentially could cover all of the city's debt. In that case, the city is the big winner there. They don't have any debt to pay. And the schools, well, I wouldn't say would be a loser, but the city, or I should say the schools in that case, don't get any upside benefit of that. And the city wants to make sure that any upside benefit is shared equally with the schools. So the number we're proposing is that the city debt is always paid to the tune of $225,000. That debt on a yearly basis could be more than that, depending on when we obviously go to market and what the debt is sold at. But that's always the minimum payment. And then any TIF revenues that pay off, that are in place and come in and are sufficient to pay off the TIF revenue, pay off the city bonds, absent that 225 floor, we'll call it, is split equally 50-50 with the schools. So that if there is any upside in the future years going out 30 years, which we would project and have projected to the city that there should be over that 30-year period, that it would be split equally with the school district. Again, I know it's just conversation now, and you don't have it necessarily in front of you. We look forward to drilling into that point in much more detail, making sure you all understand exactly what that means and why the city believes that to be a fair offer in terms of them not always getting the full upside of any future revenues coming in from the TIF.